Yo, what's going on, guys? EBS Invest here. Today we are looking at the ticker AXP, or the company known as American Express. Some people like to call this AMEX. You may have an AMEX card, maybe your friends, maybe your parents do. Not exactly sure, but some people like to say in the hip way, AMEX. Anyways, we're going to do a brief dive and overview into the stock. I would just ask you guys if you could just like the video and subscribe or leave a comment at the end. It really helps with the algorithm, and as a small YouTuber, I really appreciate it because I'm trying to grow and I really am trying to make the best content possible. So if you enjoy this video, please try and help me grow. A like and comment goes a long way. Thanks. So you can see on the max chart here, you can see that we're up 158%. This stock IPO'd back in 2007, and we're looking at a 5-year growth of 82%. This company is one of Buffett's favorites. I believe it's its third largest holding, as well as some other big billionaires also like this stock a lot too. You're looking at a market cap of $118 billion with annual revenue of $47 billion with an EPS of 9.8 and PE 15.9. That PE ratio is pretty attractive. Only thing unattractive is this dividend yield, but if we go over to the dividends, you can see that we're looking at a low payout ratio and high dividend growth. So although the dividend is low, you're going to see a high dividend growth for the next few years and pretty solid payout ratio, so you know the dividend is healthy. Checking back to when they first announced the dividend, you can see it was 20 cents, and now the dividend is going for 52 cents. So they've more than doubled their dividend in 10 years, which is pretty cool if you think about it. And now let's jump over and let's check out the revenue. So you can see the revenue is at $50 billion, give or take, minus. And you can see they've definitely increased that since 2009 from 26 billion. You can see even during the Great Recession, they still managed to increase their revenue, which is pretty remarkable. The only time that they saw negative revenue growth was probably in here. It got pretty stagnant, and as well during the COVID bubble crash, you can see that the revenue did decrease. Looking down at their quarterly growth, you can see overall in the quarterly growth, you can see their quarters have been increasing revenue, and their year-over-year growth has increased as well. Besides, during the COVID bubble crash, you can see there's a decline there and a little bit here, and like that stagnation I was talking about, there is a little bit of red down here. Overall, this stock and company has been increasing its revenue and has been doing pretty solid. Let's jump over into the income statement. So I don't really believe this revenue is accurate. We can tell over on Yahoo Finance later, but I do believe it is 48 or 49 billion. This could be a glitch for them, but if we go for that $48 billion mark, you can see they have increased it since the COVID bubble here, because at 48 here and 47, but you can see, there, they have increased the revenue pretty well. You're looking at overall, SGA is up a little bit, but not too bad. You can see that their earnings before interest and tax is up, which is pretty good. And overall, their net income is up, which is pretty cool. Going over to their balance sheet, you can see that they have a lot of long-term investments. You can see that they have a lot of cash on hand, but you can overall see that they do have a lot of debt and other liabilities. You may say that may concern you, but you have to remember, guys, this is a debt company. This company is based on debt. It's a credit card, right? So you have to remember the fractional banking system. They use debt to create more debt, which therefore makes them money, right? They're giving you small loans, and they expect you to pay big interest in return. So you guys have to remember that. So I'm not as concerned about the debt. Going over to their cash flow, you can see net income is up like we talked about, and you can overall see their liabilities have increased a little bit, but overall looking to be like their cash flow is doing a little bit better. Down here in the net cash flow, that does concern me a little bit that it is down, and it did pop during COVID. I'm not exactly sure why, but that is something to keep an eye on when you're researching this company. Like I said, we just do brief overviews here. Overall, you can see profit margins are up. You can see pre-tax return on equity is pretty solid. After-tax return on equity is pretty solid. So all good things in my eyes. Let's go over to the trading view here. Sorry guys. You can see we had a nice bull run here. Then we had the COVID bubble. Nobody could predict that. That was a black swan event. But you can see we hit and then we recovered very nicely. A big bounce. And now we're sitting right here at that $157 mark. You can see we had a recent high of $200 with a recent low of $135. And drawing this back, you can see that we're looking back to April of 2021 was the last time this stock was at this level. So you can see this stock is trading at a potential discount. We'll have to tell in our analysis in a little bit, but you can see it has been on a downtrend here. But in recent time, the stock is in a bull flag here, and so this stock could be trading like this. What I think will happen, I think this stock will trade, like I said, like this. You might see a little bit of droppage here, but I think overall we're going to see it go like that. Even if it does drop, I think in the long term, I think this stock is going that way. Now I just want to pull this up. We have MasterCard. I'm going to pull up Visa here. So I find this particularly interesting. So MasterCard has 1.2 billion cards in circulation. Billion with a B. Visa has 1.1 billion cards in circulation. Check out this revenue. 20 billion revenue from MasterCard, and then 28 billion in revenue. Okay, so American Express is bringing in $49 billion in revenue. So they don't even add up to American Express's revenue. But here's the kicker: if you divide their revenue by the amount of cards that they have, that means that each card holder is worth roughly $20 a holder, right? Just taking the amount of cards divided by the revenue, you're getting roughly $20 a holder. American Express has 58 million cards in circulation. 58 million cards in circulation, which is pretty remarkable if you think about it. And so, if I just do some basic math here, hang on one second, that means that roughly American Express card holders are worth substantially more than MasterCard and Visa card holders, okay? Because the amount of cards divided by the revenue, you're looking at like $200 to $250 a person, and you may be wondering why. They're just little plastic cards, right? The thing is, American Express has a different way of what they operate. They go and they try and go after the top 10%, upper middle class, the wealthiest Americans, and they have higher rates, higher fees, they have annual fees, and that makes up for a lot of their revenue. And the thing that you guys have to think about here is, as the world gets richer and as we develop more, do you think there will be more rich people in the world 50 years from now? I personally think so. And so you have to think more people will be using American Express cards because they have really great perks for the top 10%. And so you're going to see more cards, more people using them. That means that their revenue is really going to compound well. So after that said, let's pull up AXP here and let's get you guys, what should you even pay for this company? Because you're thinking, we're looking at low payout ratio, great dividend growth, and you're telling me that the top 10% really love this company and their revenue is more than MasterCard and Visa combined? Sounds pretty great, right? Well, let's figure out how much we should pay for this company first, okay? So you can see we're looking at a next 5-year average of 14% and a next year average of 14.7%. So let's go over towards our calculator here and let's just plug in that 9% number. Why 9? It's a little bit more conservative than 14, but I think that number is I think 9 is a little too giving. I think top 10% spending is maybe going to cool off with this recession here. They're not going to buy as many fun toys. They're not going to be spending as much. So I think if we drop this to a 7, which I think is a little bit more reasonable, we get an intrinsic value of $198, okay? Now check out this buy price, $158. The stock is going for $157.51. That doesn't mean go buy it, okay? That doesn't mean like go on your stock brokerage tomorrow, pull it up and type in AXP and buy. Do some more research, guys. Like everything Money House says, do some more research, okay? This is just a brief overview, but in my opinion, this is not financial advice. I would buy this company, and I have been dollar cost averaging in since the 140s. I think this company has a unique perspective, and Buffett says go after companies that are unique. You can't replicate Apple. You can't replicate American Express. You can't replicate Coca-Cola. Okay? These are companies that you can't replicate and have a great moat. Companies won't be able to compete with AXP because they already have the top 10% wealthiest Americans. And as the world gets more and more richer, more and more AXP shareholders and more card holders there are going to be, therefore they're going to be compounding their revenue. I find it absolutely crazy that people go for MasterCard and Visa when AXP has less cards and more revenue than them combined. So keep that in mind, guys. Thanks for your time. Remember to like and subscribe, leave a comment. It really does help with the algorithm. I would love to get to 50 subscribers by the end of the summer. Hopefully we can get there. This has been EBS Invest. Thanks for your time, guys. Bye.